Welcome to the deep dive. Today, we're cutting through the noise on two things pretty much everyone has, but, almost no one truly masters.
Insurance and bank accounts.
Exactly. The twin foundations of financial stability.
They really are. And these aren't just tedious boxes to check. This is your foundation. If you want to build any kind of wealth, you first need a solid base that protects you from getting wiped out.
Right, because a financial shock will come. It's not if, it's when.
And when it does, a car accident, a health crisis, the difference between a really bad day and a complete financial breakdown, it all comes down to the choices you made, maybe years earlier, about your policies and your accounts.
That's the dangerous knowledge gap we're here to close. We've gone through the actuarial tables, the tax code summaries, the banking reports, and our mission is to give you the blueprint.
We want you to understand the contracts you sign better than the people who sell them.
So you can avoid the fees, maximize your returns, and really sleep better at night. So let's just jump right in. We have to start with the core concept.
The absolute core. Because if you get this one thing, every other decision becomes clear.
What is insurance really? It's not a subscription service, is it?
No, not at all. It's risk transfer. That's the whole game. You are paying a small, predictable, certain cost. That's your premium.
Okay.
To transfer the risk of a huge, unpredictable, potentially bankrupting cost to someone else.
To a giant company that can actually afford to take that risk.
Precisely. And they can do it because of something called the law of large numbers.
They're not gambling. They have actuaries, statisticians who pool the risk across millions of people.
They know statistically that most people will pay in and never file a huge claim. And that pool of money is what pays for the few who suffer a catastrophic loss.
Which brings us to the key principle. What should we actually be using insurance for?
Only for catastrophic financial losses. Things that would force you to sell your house, drain your retirement, or declare bankruptcy. $1 million cancer treatment, your house burning to the ground. You insure that.
And what you don't do is use it for predictable, manageable expenses.
You'd never do that. That's why some of those, basic dental plans are a bad deal. You end up paying more in premiums over the year than a couple of cleanings would have cost you out of pocket.
And nowhere is this balancing act more complicated than with health insurance.
Oh, absolutely. The terminology alone is designed to confuse. People know premium, that's your monthly bill, and deductible.
That's what you pay first before the insurance company pays anything.
Right. But then you get into co-payments and co-insurance.
Okay, so a copay is that fixed fee, right? Like $25 to see a doctor, even after your deductible's met.
Mm-hmm. And co-insurance is the percentage split, the classic 80-20 split for a big hospital bill after you've met that deductible. It feels like your costs could just spiral forever.
But they can't. And this is the most important number on any policy.
The crucial guardrail, the out-of-pocket maximum.
The OOP max. This is the absolute hard ceiling on what you will spend in a year for covered services.
Yes. Once you hit that number, let's say it's $7,000 in a really bad year, the insurance company then covers 100% of everything else.
So when you're choosing a plan, you're really just choosing your worst-case financial number for the year. But the plans with low premiums have huge deductibles. How do you prepare for that?
And that's where insurance strategy meets banking strategy. The ultimate tool for this is the health savings account, the HSA.
The sources we looked at are unanimous on this. The HSA, if you have a qualifying health plan, is maybe the single best financial account that exists.
It's the triple tax advantage. It's incredible.
Okay, break that down.
1, your contributions are tax deductible, so the money goes in before you pay income tax on it. 2, it grows, invested in the market, completely tax-free.
And 3, the big one.
Withdrawals for qualified medical expenses are also 100% tax-free forever.
That's a combination you just don't see anywhere else. And the real kicker is what it becomes later in life.
After age 65, it just acts like a normal IRA. You can pull money out for any reason and just pay regular income tax. So it's a self-retirement account on top of everything else.
Okay, let's pivot from health to assets. Auto insurance. The foundation here is liability coverage.
This pays for the damage you do to other people and their property. And it's written as those three numbers, like 100K, 300K, 100K.
And this is where people make that classic penny-wise, pound-foolish mistake.
A massive mistake. They take the state minimum coverage to save, what, maybe $20 a month on their premium?
But if you cause a serious accident with serious injuries or an expensive car, Those minimums get exhausted almost instantly.
instantly. And if a jury awards someone $500,000, but your policy only covers $100,000,
They can come after you for the other 400,000.
they can and they will. They'll go after your house, your savings, even garnish your future wages. High liability limits are non-negotiable if you have anything to protect.
And for your own car, you've got collision and comprehensive.
Collision is pretty simple. It covers damage when your car hits something, whether it's your fault or not.
And comprehensive is for all the other stuff.
The non-collision stuff. Theft, hail, fire, a tree branch falling on it, hitting a deer, all that.
And the expert insight that came up over and over again was about uninsured motorist coverage.
Please, everyone listening, check your policy for this. It is so cheap for what it does.
It protects you if you get hit by someone who is driving illegally without insurance or who only has that tiny state minimum policy.
Given how many uninsured drivers are out there, skipping this is it's a huge gamble.
Okay, moving from the car to the house. The big number on a homeowner's policy is dwelling coverage.
As it have to equal the rebuild cost. This is critical, not what you could sell the house for.
Market value includes the land, right? And the land doesn't burn down.
Exactly. You need enough money to hire a contractor and rebuild the structure from the ground up at today's prices for labor and materials.
And then there's the distinction that can cost you tens of thousands of dollars on a claim.
Replacement cost versus actual cash value. This is huge.
Give us the example of the 15-year-old roof damaged in a storm.
Sure. With replacement cost coverage, the insurance company pays for a brand new roof minus your deductible. Simple.
And with actual cash value, or ACV.
With ACV, they say, well, your roof was 15 years old, it had depreciated. They'll calculate that depreciation and subtract it from your payout. You might only get half the money you actually need to replace it.
So you're stuck paying the other half out of pocket. You always want replacement costs.
If you can get it, absolutely.
And for anyone listening who rents,
Yeah.
we have to talk about renter's insurance.
Please, get renter's insurance.
Yeah.
It is so unbelievably cheap for the protection it offers. We're talking maybe $150, $300 a year.
That's like $15-20 a month.
And it covers all your stuff, your furniture, your laptop, your clothes. It also covers your personal liability if someone gets hurt in your apartment.
Plus, it pays for you to live somewhere else if there's a fire and the building is uninhabitable.
Yet most renters just skip it. They have this false assumption that the landlord's insurance covers their belongings.
It doesn't. The landlord's policy covers the building, the four walls, not your $20,000 worth of stuff inside those walls.
The last piece of this protection puzzle is the one most people ignore completely. Disability insurance.
The stats are pretty scary. You're far more likely to become disabled for a few months during your working years than you are to die prematurely.
It's a double whammy financially. Your income stops, but your expenses, especially medical ones, often go up.
And when you're looking at these policies, the definition is everything.
It is. You have to look for own occupation versus any occupation.
Own occupation is the gold standard.
Yes. It pays you if you can't do the duties of your specific job. So a surgeon who loses fine motor control in their hands would get paid, even if they could still go work as, say, a consultant.
Whereas
Any occupation.
only pays if you can't do any job you're reasonably suited for. It's a much, much harder standard to meet. Okay, that is a fantastic overview of the protection side. Let's switch gears to the command center, where your money actually lives and works.
The banking system. And we start with the workhorse, the checking account. It's built for transactions, but it's also where the banks lay their traps.
The fee trap, that's what the sources called it. Those $10 or $15 monthly maintenance fees from big traditional banks.
It's incredible. That's up to $180 a year you're paying them just to hold your money. Modern online banks, credit unions, they almost all offer free checking with no minimums. There's no excuse to pay that fee.
The other one is the overdraft catastrophe, that $35 fee.
It's a disaster. It can cascade. One small mistake can lead to over $100 in fees in a single day. You have to choose a bank that has low or, even better, no overdraft fees.
And a quick but vital security insight before we talk about savings.
Yes, use a credit card for your daily spending. Only use your debit card at an ATM to get cash.
Why is that so important?
The federal fraud protections on credit cards are just way stronger. If your credit card number gets stolen, you report it, and your liability is basically zero.
But with a debit card.
The money is gone directly from your bank account. And while you'll probably get it back eventually, it could be tied up for weeks while the bank investigates. It's a huge risk.
Okay, so we're spending safely. Now let's grow our cash. We're talking about the emergency fund. It has to be in a savings account, but not all are created equal.
Not even close.
Oh.
The savings account at a big traditional bank pays, what, 0.01% interest? It's functionally zero.
It's a rounding error.
This is the big aha moment in modern banking.
Yeah.
High-yield savings accounts, mostly from online banks, are paying dramatically more. Right now, 3, 4, even 5%.
And why can they do that?
Simple. No branches. They don't have the massive overhead of buildings and tellers, so they pass those savings on to you as higher interest.
Let's run the numbers because this is where it really hits home. $10,000 for 10 years.
In a traditional account, you might earn $10 total. In a high-yield account at 4%, you'd earn about $4,800
That's almost $5,000 for doing nothing.
for clicking a button one time. It's free money that's safe, liquid, and FDIC insured. There is no reason not to do this.
And for money you know you won't need for a set period of time, there are certificates of deposit, CDs.
Right. You're trading liquidity for a higher, locked-in interest rate. The catch is the penalty if you pull the money out early.
Usually a few months of interest.
Right. But for people with a bigger chunk of cash, there's a really smart strategy called CD laddering.
So instead of putting, say, 25 grand into one 5-year CD,
You break it up, you put 5,000 into a 1-year, 5,000 into a 2-year, and so on, all the way up to 5 years.
so you get the benefit of the higher long-term rates.
But you have one of your CDs maturing every single year. It gives you annual liquidity. If you don't need the cash, you just roll it over into a new 5-year CD at the top of your ladder. It's a brilliant system.
And just quickly, on institutions, it's really a choice between credit unions and online banks.
For the most part, yes. Credit unions are nonprofits owned by their members. They're great for personal service and often have the best rates on car loans and mortgages.
And online banks are for the person who is comfortable with tech and prioritizes yield.
Exactly. Highest interest rates on savings, no fees, ATM reimbursements. If you want your cash to work as hard as possible, the online banks usually win.
So this all brings up a really important question. We've got all the pieces on the board. How do we connect them and avoid the big mistakes?
The mistakes that can just negate all this careful planning.
And the first one, the most dangerous, is having too little liability coverage. We talked about it, but why is it so hard for people to grasp?
I think because people think, I'm a safe driver, I'm a responsible homeowner. But liability isn't about your intentions. It's about a moment of distraction, bad weather, an accident. And a jury's emotional response can lead to a judgment that follows you for the rest of your life.
And that leads directly to the next essential layer of protection, umbrella insurance.
This is the best bargain in the entire insurance world. It's an extra layer of liability coverage, usually $1 million, that sits on top of your auto and home policies.
And it costs what? A few $100s a year?
Yeah, maybe $150 to $300 a year for that first $1 million. It's incredibly cheap protection against a catastrophic lawsuit. Anyone with assets or a good income needs it, period.
The second mistake we see is complacency, that idea that loyalty pays.
Loyalty rarely pays in insurance. The pricing models that companies use are constantly changing. The company that gave you the best rate 3 years ago is almost certainly not the one with the best rate today.
You have to shop around.
You have to. Every few years, get at least 3 quotes. That 1 hour of work can save you hundreds, sometimes thousands of dollars.
And the third mistake, filing small claims.
Right. Don't use your insurance as a maintenance plan. If you have a $2,000 claim and a $500 deductible, think twice before filing.
Because that claim goes on your record.
And your premiums will likely go up for the next 3 to 5 years, costing you way more than the $1,500 you got from the claim. Save insurance for the big stuff.
Finally, let's tie this back into tax strategy because this is where you can really amplify things.
We talked about the HSA, which is the undisputed champion. It's your health protection and a tax-free wealth-building machine all in one.
And the smartest way to use it is to not use it.
If you can afford to, yes.
Yeah.
You max out your HSA contributions to get the tax deduction. You let that money grow and compound for decades, and you pay your current, smaller medical bills out of pocket from your high-yield savings.
You're creating this massive tax-free bucket of money for retirement health costs, or just for retirement in general.
It's an incredibly powerful strategy.
So after all this, what does it all mean for you listening? You now get the strategy behind the jargon, you know what an out-of-pocket max is for, and you know the difference between actual cash value and replacement cost.
And you know your emergency fund should be sitting in an account that's actually earning you real money, not sitting in one that's costing you in fees.
Insurance is that foundation. It's what lets you build wealth without the constant fear of one bad day wiping it all away.
And your needs change. Your assets grow. You have to review your coverage every single year.
And that brings us to our final provocative thought, the thing we want you to take away and act on.
It's the connection point. It's where your insurance choices and your savings choices come together to create an optimal strategy.
You should seriously consider carrying the highest insurance deductible you can comfortably afford to pay out of your emergency fund.
Think about what that does. A higher deductible immediately lowers your monthly premium, sometimes by a lot.
So you're saving money every single month.
And you are effectively using your own money, that high-yield savings account that's earning you interest, to self-insure for the small, manageable losses.
While leaving the insurance company on the hook for the truly catastrophic stuff, which is what it was designed for in the first place.
Exactly. So now, go review those deductibles and check your savings account's APY.